So tonight we're going to talk a little bit about real estate myths. I'm sure you've heard some of them. I wanted to start off with a slide here that talks about stocks versus real estate, right? So on real estate, you get cash flow, you get leverage, it's real assets with tax advantages. Obviously, on stock, you get cash flow and leverage, but you don't normally get the last two. On bonds, you do get some cash flow, no leverage, no real assets, and there are some tax advantages. And of course, if you decide, oh, I'm not going to invest, I'm going to save my money. We all know, especially with the inflation rate, you're losing, you have no cash flow, you have no leverage, you have no assets, and you have no tax advantages. So super important for you to understand. Doesn't mean we're not saying don't have any stocks or bonds. We're just saying the real advantages with stock real estate investing is powerful. So myth number one, you can control all aspects of investing. I like it when he pops up something new here, keeps me guessing. Control you are not in. Unless you are out of control, you are. That's a tough one to say, but it's very powerful. You cannot control all aspects of investing. Even active investors can't control market conditions, regulatory changes, and unexpected challenges. Now, do we plan for them? Do we try to do worst case scenarios? Do we put everything we can in to say, okay, we've got everything covered? Absolutely. Do we always have everything covered? We do not. There are things that happen, and the power of a team is somebody who can help make those changes, can help implement the things that happen. So again, you need to understand that while real estate is our favorite means of investing, it's very safe way to do it. There's a lot of growth. Real estate is always growing. Many of people have you heard me say 90% of all millionaires became so through real estate, but you cannot control everything. Active investing is too time consuming. All right, it's a lot of work, right? Okay, with proper systems and teams, active investing can be managed effectively, but it still requires attention. It's one of the most important things I've learned since I've been doing through real estate investing. I did a presentation a couple of weeks ago about the power of team. You need a team to be able to manage your real estate investments. Otherwise, you're doing everything yourself. Passive investing is completely hands off. Time is money. False. This is a mismeasurement duration. Money is a medium of exchange. Passive investing still requires regular reviews, occasional adjustments, and decision making in response to market conditions. So even though you're passive and we're taking all the responsibilities, you still have responsibilities to make educated decisions.
Robert, let me jump in and add a little bit more, right? For us, and as some of you guys been following us, as a passive investor, you are building, or all of us, we're building our portfolio of investments. That needs to be, and that should have a risk distribution in terms of geographical location, in terms of time, in terms of asset classes and asset types. So you should have that as a part of that as you go, right? Sometimes we could see which way market is going, and sometimes we can't, but we can predict a version of it, right? So just like stocks, you sit down, look at your 401k, you have debt, you have stock, and within the stock you have international and local, and then within the local you have the domain that you're expert in, plus the other domains that you know. Just like that, you need to sit down time to time and say, hey, I have done 15 passive investments, or from the 15 I have done 2 in Texas, or 2 in somewhere else, or have done some cash flowing triple net assets, some land development, some multifamily. So if I put it together, my portfolio behaves like a risk adjusted portfolio within the real estate, very similar to the stock market. So it takes a little bit of thinking, but what we recommend, all of us, we should review our portfolio and adjust as we go. Not, so we always say every cycle is a cycle to buy. It's just not the way you bought it in a previous cycle. Over back to you. Thank you.
Absolutely. So single fam, who here has single family homes and believes they're easier to manage, right? For anyone who knows me knows that I never did the single family route. I was terrified of toilets, tenants, and trash. Every time I called somebody to fix something at my house, they didn't show up, they charged me too much, and they never fixed it. And I thought to myself, why in the world do I want to make that a job? Why do I want to do it? So while single family has been seen simpler to manage, they often require the same level of attention as apartment complexes. Apartments benefit from economies of scale where maintenance, management, and costs can be more effectively managed across multiple units. I talk to a lot of new investors and they're saying, well, I'm going to start with this and I'm going to start with that. I always like to say it's the difference that, yes, you're still investing in real estate, but to be perfectly honest, when you're buying small apartments, duplexes, triplexes, quads, you're actually buying yourself a job. Now, it could be a really good job, and that job could really appreciate over time. But you must understand that you are responsible for everything. And again, that is a lot of work. Anybody who's in that space. Apartments require more capital than single family homes. Okay, while the purchase of an apartment building is higher, investors can participate in apartment investments through syndication, REITs, or partnerships, often requiring less capital per investor than purchasing multiple single family homes outright. So think about this. You can be a partner in 100, 200 plus apartment complex. We talked a little bit about our opportunity in San Antonio. That's 204 apartments and you can get into that deal with a $50,000 investment. It's going to take you at least that to buy into get a single family rental property. And if you think about that, we have 204 units. If 10 tenants up and move out tomorrow, we're okay. If you have one home, you're on the hook for the mortgage, and that one tenant moves out, and on the way out, they decide they're going to trash your property, you all of a sudden now have a big problem on your hands. The stock market is easier versus syndication. Many assume that stocks are simpler because they're more familiar, but the stock market's complexity and the factors fluctuating stock prices can be challenging to navigate. Real estate syndications, on the other hand, have a more straightforward investment structure with predictable income streams and transparent operating expenses. So I know myself, I had all of my money before I got into real estate in the stock market. And it was absolutely a wild ride, right? Things that happened that had nothing to do even with the stocks I owned, the stocks went down. I mean, Russia invades Ukraine and my stocks go down. I don't have any Russian stocks. I don't have any Ukrainian stocks, but world events have a much bigger significance on the movement within the stock market. I see you've unmuted there, Shara. Watch him unmute, and I know he wants to talk. I get him
Uh,
figured out now.
no. So this one really makes me smile. Smile in a sense, everybody thinks. So if you think about the pricing theory, if everybody knows what's going on, then by the trades, stock prices, it's in equilibrium. That means if I buy something for $10, I'm assuming Shell is gonna do good. Then Trevor, good. Then $10 to the market price. But then usually I would buy $10 thinking, I know something more than Trevor does. Hence, if I buy something at a $10, it is worth maybe $12, right? That's the premise whenever we buy stock. And that is so not true, right? Coming out the B school, I used to do an option trading at Bloomberg Terminal. Then over time, you realize doesn't matter how much we know as an individual level, we are uh, very not so sophisticated investors. The PE shops, the hedge funds, they have additional data, they have more access to information, they have more model, they're extracting the value out of us. By the time we get to make a trade, we're emotional, buyers and sellers, not really a technical buyers and sellers. That's one. I'll give an example. I thought back in the days we knew a lot. I had two stocks that I bought up until today went to bankruptcy. I remember after the financial meltdown, I bought Fannie and Freddie because of the whatever reason that we had, and it worked out really, really well. When Europe went down, I bought we bought some of us we bought Bank of Greece. I thought, well, with our Bank of Greece, Europe is not going to let it go down. And then one spot I remember we miscalculated, which is Greece. Their economy is as big as much of I think as back then it was similar to Maryland. Think about one state versus the whole country, and we're thinking Europe is gonna let it go. They let it go down. We went to work. We had tons of money. We got out. Money is gone. The beautiful thing is about stock is you make a lot, but you can lose a lot. At the same time, we are not in control of anything. If Shell does what Shell does, when I buy Shell stock, there's nothing I can do about it. I'm just riding to that. So for all of us, we need to reflect on it and say, if I buy a stock, I'm really rolling the dice. There is not much additional information we have. On the flip side, when I look at a syndication, right? If I'm an LP, if I'm an investor, think about this. I have access to the C-level team. I am close to the asset. I know what they're thinking. I know where they show up. And I can also call a bunch of times to maybe input something. So you can influence a 10, 20, 30, 40, $50 million deals, even though you are a passive investor. Uh, and a stock owner. That's to me it means a lot, which is why I mean personally I moved everything almost to hard assets, and that's and if you do it right, which is the portfolio optimization we talked about, you can create an investment portfolio that would behave like your stock portfolio. So that's there. Back to you, Trevor.
Awesome. It's funny. I got a funny story here. I like to do funny stories once in a while. So my son convinced me to buy cryptocurrency. Okay. And you want to talk about a wild ride. Now I'm ahead. I doubled, it was more than double my money, so I took it out. So I'm ahead. And in a few months, I'm turning 65. And I have a joke. I'm either buying a cup of coffee or I'm going on a trip around the world. Um, because it's just so volatile. Some days I wake up and it's like $10,000 down, and the next day it's $5,000. It's almost, again, I hope I do well, but I'm not controlling anything. I'm just on a wild bore going through it. So, how many people were told you buy real estate and you get rich quick? Right? How many of those mastermind courses that you signed up for or went to, they said, man, join our program and your first deal, you're gonna be sitting on the beach drinking pina coladas, property manager's gonna be doing everything, and the cash rolls in. All right. Real estate investing, you get rich slow. It takes time. And I've talked about this before. If you consider, we talk about how real estate, and Robert Kiyosaki's book is amazing. It teaches the power of leverage, right? How we use leverage to grow our wealth. That's the leverage, and the tax advantages are the two things that make real estate in a sweet spot. But think about this. I talked about this before. Invest 100, double it in 2 years to 200, or 5 years, pardon me, assuming no tax complications, and you do double your money. 200 goes to 4 in 5 years. 4 goes to 8. 8 goes to 1.6 million. 1.6 million goes to 3.2 million from your initial $100,000 investment, assuming you always reinvest and compound your money. At the end of the day, whose life would that change, right? 25 years to be able to grow from a $100,000 investment to a $3.2 million investment. So you get rich slow. And I want to make sure that people understand that, right? It is a powerful way to grow money, but it's not the lottery. I created a little YouTube video here. I'm going to pop it in the chat. If you get a chance, take a look at it. If you don't mind, subscribe. So I talk about passive investing very much like buying a ticket on an airplane. All right. So you're making a passive investment in commercial real estate. Your role in the transaction is very similar to buying an airplane. You literally have no responsibilities. How many people would get on Southwest if they realized they had to fly the plane? They had to make sure there was fuel in the plane. They actually had to know what all those buttons in the cockpit did. I wouldn't be flying. I just wouldn't be flying. So you invest, pay for the journey for financial independence because other people are there. Again, like an airplane, the senior executives who operate the entire business, those folks are the same as the sponsorship team. Then you have a pilot. The pilot is responsible for flying the aircraft. They're like the asset manager. They're the person that's in charge of making sure the metrics of the property are happening. They often are part of the sponsorship team. They're often managed by the sponsorship team, but they are the ones that are responsible. Then you have the support team. These are the people who maintain the airplane, flight attendants. That's like our property management company. They're the ones who run it, right? So we have, if you think about it, right? We have an airplane, we're going to take you on a journey. We're going to take your money and bring it to a destination with a goal normally to double your money in 2 years. But you don't have any of the responsibility. Now, do you go on an airline you've never heard of? No, probably not. Do you go on an airline that has a bad track record? There's a crash every other day, but it's okay because I don't think they crash on Tuesday. I'm going to go for the ride, right? So you have responsibilities to vet us, to vet sponsors. But at the end of the day, it's our responsibility. You trust us to be able to take care of it, to manage everything, which is the big difference between house rentals or everything. You're responsible to manage everything. And to be honest, you get, obviously, if the market goes up, you do well. And if you get good tenants, you do well. But if all those things go wrong at the end of the day, there's no team for you to be able to call on and say, hey, can you take care of this? So same thing happens when we sell it. You receive your share of the profits. Your trip is complete. And again, I talked on a 5-year cycle. The goal is to double your money and you're ready for the next trip. So make sure again that you're taking the next trip, right? So we talk a little bit for those who are new that every deal is somewhat different, but it's very typical for you to have a 70-30 split. What that means is 70% of the funds go to the passive investor and 30% goes to the general partnership team. That's how us as active sponsors make our money, pay our overhead, do different things. There's often a 7% preferred return payment. That means until investors get a 7% return, the general partners are not eligible for the distribution. So this is a very investor first centric. Massive Capital runs all their deals this way. Distributions are often made quarterly, and I did put if at all. Sometimes it takes us a little while to be able to do it. And it depends on the type of investment. So our new build retail, some of the ones there are no cash flows. The value end comes at the end on a sale or a reposition. And I've mentioned this many times. The goal is to double your investment over a 5-year period. Again, we talked about that you are responsible to do all assumptions, double check, ask questions. I hope this understands on passive investing.